All right, let's talk about NVIDIA. The stock has been on an absolutely unbelievable tear. But the big question on every investor's mind is, how much higher can it possibly go? Well, Bank of America just dropped their latest report, and they're making a pretty bold case for the stock to hit $235. So today we're going to unpack that. We're going to look inside the report and see exactly how they got to that number.
Okay, but before we dive in, we have to start with the fine print, which is right there at the top of their report. Bank of America is very clear that they may have a conflict of interest and, super important, that this analysis should only be one single factor in any investment decision you make. So let's just keep that in the back of our minds as we go through everything. And here it is, the title of their report. It's punchy, it's confident, and it pretty much tells you their entire stance right from the get-go. They see a solid setup in what they're calling the most attractive, most visible growth opportunity out there. No beating around the bush here. So let's get right to it. Beyond that big headline number, what's the actual foundation of their argument? What's the bottom line up front? Well, Bank of America is reiterating its buy rating, and they're calling NVIDIA their top pick in the whole sector. Their reasoning really boils down to a few key pillars. First, just absolute dominance. We're talking over 80% of the AI market. Second, incredible profitability, with free cash flow margins north of 45%, which is just staggering. And third, and this might surprise you, what they actually argue is an attractive valuation. We'll get to that. And this, of course, is the number that grabs all the headlines. They are officially raising their price objective, or PO, from $220 all the way up to $235. It's just a really clear signal of their increasing conviction and where this company is headed. Okay, so what's actually driving this confidence? Where's it all coming from? The report breaks it down into three key technological pillars that are basically firing on all cylinders right now. What's so fascinating here is how BofA lays out this multi-layered growth story. It's not just one thing. First up, you have the present. The brand new Blackwell Ultra chip is ramping up at a massive scale. We're talking 1,000 racks per week. Then, their networking business, the stuff that connects all these chips, is just exploding. Spectrum-X has already hit a $10 billion annual run rate. And finally, they're not resting. The next generation Rubin platform is already on track for 2026, which BofA believes keeps them way ahead of any competition.
So those are the engines, right? But just how big is the road that they're driving on? BofA spends a lot of time trying to quantify the sheer scale of this AI market opportunity.
And according to their model, the total addressable market, or TAM, for AI data centers is projected to hit a staggering $823 billion by the year 2030. Now, let's try to put that number in perspective. Just look at this chart. See those blue bars on the left? That's the explosive growth they're forecasting for the AI data center market. It's a rocket ship. Now, compare that to the gray bars on the right, which is the traditional non-AI data center market. BofA sees that as staying almost completely flat. It's clear, all the growth is in AI. And if you think Bank of America's numbers are huge, get this. The report notes that NVIDIA's own internal forecast is even bigger. The company itself sees a mind-boggling $3 to $4 trillion with a T being spent on AI infrastructure by the end of the decade.
So what does this all mean for the bottom line? That's the crucial question, right? Well, both this model, which they say is grounded in the industry's growth path, suggests that NVIDIA could generate over $10 in earnings per share by the calendar year 2027. This number right here is really the financial destination that their entire thesis is pointing towards. But of course, no analysis is complete without looking at the other side of the coin. And to their credit, the report is very clear about the potential risks. What could actually derail this whole scenario?
They really boil it down to two main concerns. First is the ongoing uncertainty around China. Geopolitical restrictions could definitely impact chip shipments. And second, kind of flowing from that, the pace of analyst upgrades to earnings estimates might slow down a bit in the short term, especially compared to the crazy fast increases we've gotten used to see. But here is an absolutely critical piece of context. You have to hear this. To be conservative, Bank of America's model, the very one that gets them to that $235 target, it completely excludes any potential revenue from China. They've essentially modeled a worst-case scenario for that market, and they still arrive at this really bullish conclusion. That's a huge deal.
So this all leads us to the big question, the elephant in the room that dominates pretty much every conversation about this company. Let's move on to the valuation and see how this report tackles it. I mean, this is the number one pushback you hear, right? The stock has gone vertical, it's had this incredible run, so it must be wildly expensive. But BofA argues, maybe counterintuitively, that it's actually not. And to make their case, they focus on this really cool metric called the PEG ratio. The idea is actually pretty simple. You just take a stock's normal PE ratio and you divide it by its earnings growth rate. A number around 1 is often considered a fair price for a company that's growing.
And here is the core of their entire valuation argument. This is the punchline. Based on their 2026 estimates, NVIDIA's PEG ratio is just 0.9. That's actually below 1. Meanwhile, the average for the rest of the Magnificent 7 stocks? It's almost 4 times higher, sitting at 3.9. That's a massive difference.
And the full data from their report makes this even clearer. You can see it right here. While NVIDIA's PE ratio of 30 might look kind of similar to, say, Microsoft, that's not the whole story. The real story is its growth. Once you factor in that massive 34% projected earnings growth, you get that PEG ratio, all the way over on the right, of just 0.9. It tells a completely different valuation story than its peers. And just to show that they're not pulling this methodology out of thin air, they base their $235 price target on a PE multiple of 37. Now that multiple lands right in the middle of NVIDIA's own historical trading range of 25 to 56. So it suggests it's a pretty reasonable valuation based on the company's own track record.
So at the end of the day, what this Bank of America report really leaves us with is this final powerful thought. They, and NVIDIA itself, see a future with a $3 to $4 trillion AI infrastructure market on the horizon. From that perspective, maybe the right question isn't if the company will continue to grow, but rather just how much of that enormous future it's positioned to capture.